Alrighty, it is exactly 9 o'clock. There's no better time than 9 a.m. to get started. So let's get started. Welcome to today's presentation, Looking for a Life Raft, presented by OmniaHR and Precision Tax. I am your host and moderator, Arwen Robinson with Advanced Benefits. And today I am very excited to take you through this presentation this beautiful, chilly morning. We have some great speakers lined up for you today. And if you have any questions during the presentation, please utilize the chat function. We will have a Q&A period at the end of the presentation. But if you have questions throughout the presentation, feel free to go ahead and pop them in. I may call them out, mid-presentation, or we'll just make sure that they get covered by the end. This presentation is being recorded. If you do not wish to participate in a recorded call, please disconnect yourself at this time. This presentation is a courtesy service for our clients and for our dear friends. It is designed only to give general information on the developments actually covered and is not intended to be a comprehensive summary of recent developments in the law, treat exhaustively the subjects covered, provide legal advice, or render a legal opinion. Very important. We are not lawyers. Advanced Benefits, OmniaHR, and Precision Tax and its employees are not attorneys. They're not responsible for any legal advice. To fully understand how this information or any legal or compliance information affects your unique situation, you should check with a qualified attorney. That's my legalese disclaimer here before we get started. So again, welcome to the presentation, Looking for a Life Raft, where we're going to be reviewing the small world of small business compliance. I'm really excited to go over with you today. We've got some great speakers. We have Michelle Walsh, who is the lead bookkeeper at Precision Tax, as well as Starlyn Nip, who is the senior managing tax accountant. And we have Carrie Straw with us here today as well. She is the VP of HR Services for OmniaHR. And between the three of these presenters, we've got some great information we're going to cover here today. Today's goal is to take you through some of the most common mistakes that small businesses make when it comes to compliance, specifically in the realm of human resources, taxes, bookkeeping, all those different, really technical aspects of your business where it's really easy to make mistakes and there's a lot of regulation. We want you to walk away today with some best practices and ideas that you can take back to your business to possibly implement for 2023, as well as identify areas where you may need some improvement. After this webinar, you might go, ooh, this is a little uncomfortable because I'm not super strong in this area. And this is an opportunity for you to recognize and realize where there may be some opportunities to either improve or just completely outsource it and say, you know what, I need a professional to handle this. I'm not going to handle this anymore. So the first section we're going to talk about here is crashing through the seas of compliance. We're going to talk about all the different aspects of compliance in your small business. And the really important thing that we want you to keep in mind throughout this presentation is that you don't know what you don't know. The goal of this conversation is for you to become aware of those things that you might not otherwise be aware of, because unfortunately in the realm of compliance and regulation, not knowing about a rule or regulation does not excuse you from any penalties or consequences with the governing agency. So we're going to talk about what you need to be aware of as far as bookkeeping, taxes, different company type benefits, employee records, and HR rules. So we're going to kick off. First and foremost, I'm going to hand the mic over to the lovely Miss Michelle Walsh. She is a CMA, lead bookkeeper, and QuickBooks certified provider. So with that, Michelle, welcome. You have the mic first. And I'm really excited to hear all about what you have to share with us this morning.
All right, thanks, Arwen. Yes, I am Michelle Walsh. I am the lead bookkeeper here at Precision Tax. This morning, what I'm going to do is just kind of briefly go over some of the various reporting and record keeping requirements that most businesses need to be aware of so that you can stay in compliance and avoid the penalties and late fees and the headaches that go along with interacting with all those various agencies there. So these are also areas that we've seen some of our bookkeeping and tax clients get into trouble with in the past. And when they have, it's never been intentional on their part. It's always just been so busy doing all the other many things that small business owners especially are doing, that they just don't even know that this is something that they should be tracking or they should be reporting or anything like that. Like Arwen said, you don't know what you don't know. So the first thing I'm going to tackle here to go over is sales tax. So first of all, if you are in Idaho and selling a taxable product, you need to have a seller's permit. And sometimes this is called, a sales tax permit or a sales and use tax registration number, but it's all the same thing. It's just a seller's permit. It's really easy to get. You can apply online and you can get it within probably 10 days, and best of all, it's free. So that's the first thing. And then the second thing is, do you need to be collecting sales tax on your business transactions? And it kind of depends on what kind of business you have. So if you're a service business, a plumber, an accountant, something of that nature, then probably not. Most labor is not subject to sales tax. The only time that this can get a little tricky is if you are selling your service and parts. And if you break out them separately on your invoice, then you're going to want to go ahead and charge sales tax on the parts. For instance, you're going to run down to Les Schwab and put 4 new tires on your truck. You're buying the tires from them and you're going to have them mount and balance. When you get your invoice from them at the end of it, the mounting and balancing, they didn't charge you tax, but the tires they did. So if your business is anything like that, that's something to be aware of. If you're a wholesale business, let's say you make custom cutting boards and then you sell them to various shops who in turn sell it to an end user. When you're selling to the shops, you do not need to collect sales tax. They will collect sales tax when they sell to the end user. You are going to want to have a exemption certificate on file to show that you're selling wholesale, to cover your butt in case you ever get audited in that degree. And that does apply in both Washington and Idaho. If you're a retail business, then you are probably going to be needing to charge sales tax. You will, on the other hand, when you're purchasing the goods that you are selling, as long as you have a resale certificate, you should be able to purchase those tax-free. But when you sell them to the end user, you are going to want to charge sales tax, which then brings us to, what rate do I charge? Most sales tax rates anymore are destination based. So I'm here in Idaho and I buy something online from somebody and I have them send it to my kids in Washington because it's going to Washington. I'm going to pay whatever the sales tax is in Washington. If I order something from Washington and have it sent to me here in Idaho, they're going to charge me the Idaho sales tax. So it's really where the product's being taken possession of. This can get really tricky and complicated if you are primarily an e-commerce type business, but a lot of the online platforms that you use for that purpose have that functionality built in, but it can get really tricky if you're selling products to across the country because then you're dealing with so many different tax jurisdictions. I'm not going to go into that much anymore because really it's such a big issue. It is worthy of its very own webinar. So if you're in Idaho, you're lucky because basically it's a flat 6% rate. There are a handful of cities, mostly resort cities, where there may be a local sales tax, which is generally charged on things like lodging and restaurant meals, drinks in a bar. Sandpoint is probably the closest one to us here that does have a local sales tax. So if you do business in Sandpoint, you would want to contact the city and just see if the product that you're selling is subject to that additional local sales tax. Washington State, on the other hand, is much more complicated because besides the 6.5% sales tax at the state level, there are a variety of different rates based on the city, the county, certain municipalities, special zones. It's just a ton. But the Washington State Department of Revenue on their website has a handy tool called Find Sales and Use Tax Rate. And when you go there, you can just put in the address where the transaction is taking place, and it will tell you exactly what rate to charge. So now you know whether you have to charge sales tax, how to find the rate. It's important to realize that The sales tax is not revenue to your business. It is merely funds that you are collecting and holding until you remit it to the correct agency. So when you record that in your books, you want to make sure that you're not lumping the sales tax into your sales. If you sold something for $100 in Idaho and you received 106, you would book that $100 to your sales and the $6 to sales tax payable. So kind of going hand in hand, this would be the next slide, Arwen, is use tax. So what is use tax? Use tax is if in your business you purchase something that you should have paid sales tax on and didn't, then you need to report and remit use tax to the state. For instance, let's say you order business cards for your business from a printer in Michigan. They send you the business cards and an invoice and they didn't charge you any tax. Then the amount of those business cards, you would need to remit the use tax to your home state, whether it's Washington or Idaho or wherever. The other thing to remember is that if you are normally a retail business, and the stuff on your shelves you bought tax-free, you collect tax when you sell it. If you take it off your shelf for use within your business or as a giveaway, anything like that, as soon as you do that, that is now subject to use tax, and you would report and remit that as well. Use tax rate is the same as the sales tax rate. So that makes that very easy. But unlike sales tax, use tax actually is an expense to your business. You still owe it and you need to report and pay it. But instead of collecting it from a customer, you're collecting it basically from yourself. So depending on your accounting software, maybe every time you do that, you do a transaction in your software and you record it to expense and to use tax payable, or you may keep track of it throughout the month on a spreadsheet and then just do a journal entry at the end of the month. But it is important to keep some sort of record of items that were subject to use tax. That will help you fill out the report when you have to do it, and in case you ever have to go back and look at your records. And as far as reporting and remitting goes, generally, you are required to report sales tax and use tax and remit those amounts to the state once a month. So anything that you collected sales tax on in February, you would turn around and remit in March. So the next slide is about payroll taxes, of which there are very many. There's state payroll taxes, there's federal, there are taxes paid by the employee and some paid just by the employer. There's various agencies and various frequency of reporting requirements. So let's start out with the federal payroll taxes. So we'll look at federal payroll taxes that the employee has to pay. And these are funds that are withheld from their paycheck that you hold on to and remit. So again, not an expense to the business. There's the federal income tax based on the W-4 the employee filled out. And then there's FICA, which is made up of Social Security and Medicare. Social Security is 6.2%, Medicare is 1.45%. The important thing to know here is that there is a wage limit on Social Security. For 2022, it was $147,000. They bumped it up just a little bit for 2023 to $160,200. Medicare, there is no limit, whether that employee makes 10,000 or 10 million, they're paying Medicare on all of it. So then on to payroll taxes that are the employer's responsibility. The employers are also responsible for FICA taxes, same rates as the employees. And this is important to note then for self-employed people. For self-employed people, you get to be the employee and the employer. So you would pay the full amount of Social Security, which would be 12.4%, and you'd pay the full amount of Medicare, which is going to be 2.9%. So a little bit more there, something to be aware of. And then the other tax that employers have is the federal unemployment tax called FUTA. And that's basically, there is a wage limit on that too. They charge 6% on the first $7,000 in wages, unless the business or the individual is also paying into a state unemployment insurance. And if that's the case, then the rate at the federal level drops down to 0.6%. So $7,000 in wages in a year, you'd pay $42 for that employee. And then as far as remitting and paying, federal payroll taxes are usually paid every month. Some really small businesses might be allowed to pay quarterly or even annually. Businesses that have large payrolls often have to pay semi-monthly, basically at the end of each pay period. FUTA is paid annually, basically due by January 31st after the end of the reporting year. Reporting is a little bit different. Not so much for FUTA, you use not Form 940 and you report that annually, but for the FICA taxes and the federal income tax, while you pay that every month, you have to report it quarterly on Form 941. So that can get a little bit confusing for some clients, but it's important to remember, pay every month, but report on the quarterly basis. So now we'll move on to the Idaho payroll taxes, because there's other taxes that are on the state level. So Idaho is a state that has income tax. So that is an employee withholding from their pay. And generally you report and pay that on a monthly basis. It's a Form 910 for the state of Idaho. And then again, at the end of the year on a separate form, it's an annual Form 967 due at the end of January after the end of the year, that goes back and reconciles basically your total wages to what you paid throughout the year. And then that's your opportunity to pay any shortfall, or if you're lucky, request a refund if you overpaid. The other item on the state level is state unemployment insurance. And in Idaho, that is a 100% employer expense. It really varies based on experience factors, what kind of company you're in. It can be anywhere from 0.2% up to 5.4%. If you have a lot of unemployment claims, your rate is going to be higher. But that is something that is reported and paid on a quarterly basis. The other one in Idaho is workers' compensation, which again is an employer's expense that does not get contributed by the employees. And similar to the unemployment insurance, it really, really varies on a number of factors: what type of industry you're in, how many claims have been made, the number of employees. It's just really important to remember to get the correct classification in the first place. You don't want to be with paying workers' compensation rates as an office type job if you're actually construction. And you can end up paying some penalties if it turns out you classified incorrectly. And then Washington. Washington is a little bit different. No state income tax, yay for that. Workers' compensation, again, most businesses pay that through Department of Labor and Industries. I think there's a few exceptions that can be made, and you can find that on their website, but the bulk of it is going to be through L&I. And a small amount of your annual rate, and it will tell you on your annual rate notice, can be taken from the employee's check, but it is a very small amount. The bulk is paid by the employer. Washington also has a unemployment tax, kind of a similar situation, reviewed on an annual basis. They also have the Paid Family and Medical Leave Act, which they made excessively complicated. How much is paid by the employer? How much is paid by the employee? It differs if you have under 50 employees, if you have over 50 employees, and they really split that up into some random amounts for each party there. So fun and games in Washington. And then the final Washington state payroll tax is still kind of in flux. That's the Washington Cares Fund, which is a long-term disability program. They keep pushing this date out. It looks like I checked earlier this week, and they've now pushed it out to July 1st before they start taking these. And this is a completely employee paid, so no expense to the employer. So, and you can see in Washington State, there's quite a few additional taxes that need to be accounted for besides the federal and then the common ones between the states there. And then that leaves just a handful of additional Washington taxes if you're a Washington business. There's the business and occupation tax, which is basically, unless you're a really small business doing it on a quarterly basis, you are doing monthly. They have made 5 major classifications, such as retailing, manufacturing, wholesaling, and then they have 31 specialized classifications. So it can get a little bit complicated. And if you're a Washington business, you want to make sure and really do your homework and see if your particular business falls into one of those classifications. And in addition to that, there are 45 different additional business taxes. Les Schwab, where you got your tires done, they have to pay a tire fee for every tire they dispose of. If you rent heavy equipment, there's an additional tax that you have to pay. So if you are a Washington business, there is a lot more due diligence that you're having to do to make sure that you are staying in compliance. But the number one thing that I really, really want to leave you with here is there are all these different reports, monthly, quarterly, annually, sales tax, payroll taxes, B&O tax, all that. The really important thing to remember is even if you have no activity for that period, you still need to file the report. Let's say you have a fairly seasonal business and the first quarter of the year, you didn't have any employees. So you had no payroll taxes to report on your quarterly 941, you still need to report the 941, you still need to submit that report, even saying just $0. Kind of the same thing with sales tax in Washington. If you had a month where you didn't collect any sales tax, you still need to file a no activity report. Because this is where a lot of people get into trouble. You say, hey, I don't have any employees. I don't need to bother filing that 941. And then a couple months later, you get a notification saying, hey, we didn't receive your report. So now you're getting a penalty for not filing. And this is how much based on your past history you probably should have paid. So that's due. And because it was late, there's late fees and now there's interest. And so all of a sudden you had no payroll taxes you even had to report. And now you're getting told by the reporting agency that you owe a ton of money. So please, 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 always file that report, even if you don't have any activity. And so that kind of wraps it up for me. I'm going to pass it on back to Arwen here. And thanks so much for listening.
Yeah, they don't make it easy to do business in Washington, do they, Michelle? Oh my gosh, goodness sakes. I can't believe that you can keep it all straight, Michelle, honestly. So, Michelle, before we transition to Miss Starr, I have a couple questions for you.
Okay.
We have one question regarding, and of course, in our area, since we're so close to Washington, it's very common for a business to operate in both, have employees living in both, that sort of thing. So if you are an Idaho-based business and you do business across the border, the question here specifically is, if I'm located in Idaho, I do business in Idaho and Washington, we pay excise tax in Washington. Do we need to pay sales tax on job materials installed from the supplier? We do have a reseller's permit, and our materials and labor are grouped as an install package, not separate on the sales receipt we provide to customers. What's your thoughts on that?
My thoughts, and in my experience, if you're not breaking out the parts, if it's just a whole installation package, we're installing this. Let's say you're installing a deck package, okay? You're putting in this whole thing. I don't think that you have to break out the parts and pay sales tax on the installation of the whole thing. It kind of depends. I know if you're a subcontractor, it's on the general contractor, if it's that sort of situation, to pay any associated taxes. That is an issue that can get a little bit complicated depending on exactly the business. If you're paying excise tax, that can be still on wholesale and not necessarily subject to sales tax. You'd have to really see the details of it. But I think if you're not breaking out materials, you're probably okay.
Mhm. Yeah, and I would really encourage if there's like a highly specific situation that is specific to your company or your industry and that sort of thing, I would say engage with Precision Tax. They're a great resource. They're able to, you know, work with you to kind of get these specific questions answered. So another question we have is, and this is one we get a lot, is we have employees that work in Idaho but live in Washington and vice versa. What does that look like if I am a Washington employee and I work in Idaho? I'm not paying income tax in Washington, but I'm in Idaho. I'm working in Idaho. Am I paying Idaho income tax even though I'm a Washington resident?
I don't think so. When I was at a prior employer, they are based in Idaho, but they had a couple of employees that lived in Washington. And I know since if their work was being done in Idaho and the main location of the business was located in Idaho, then I know that we did not have to collect those Washington taxes like the paid family leave. We weren't paying unemployment to Washington. We were paying it to Idaho. And I'm really sorry, I can't remember exactly if they had to pay income tax or not.
It's all right.
I
It's
can
highly
answer.
highly
They
specific.
do.
It really is.
It is. It really, really is. Do you know that one, Star?
They would have to pay income taxes to Idaho. If they're working in Idaho, there is state income taxes. And unfortunately, if you actually reside in, let's say you resided in Montana, which is a state income tax state, and you worked in Idaho, you have state income taxes to both your resident state and the state that you're working in. A lot of times you get a tax credit for taxes paid on your resident state return, but there's still taxes that you have to pay to both areas.
Yeah, man, they don't make it easy when they go across states, do they? No, and I appreciate your insight, Michelle, and your all the different, you know, it's so complicated. I was thinking as you were presenting, you know, things like, oh, are you selling a service? I know that I had that happen where my husband is a professional photographer and he's selling a digital product, and for him the trick is if he's delivering his photos on a USB stick, suddenly he has to pay taxes because it's a physical thing. But if he's not, it's just the difference of a USB stick is taxes or no taxes. So sometimes it's the silliest things that trigger taxes. So it's definitely no easy world to navigate, and I'm very appreciative of your insight. So thank you so much.
Thanks.
All right, we're going to go ahead and turn it over to Miss Starr. She is a CPA and the Senior Managing Tax Accountant at Precision Tax, and she's going to be talking us through the different tax scary implications. And so, Starr, we're going to go ahead and turn it over to you, and I will do my best to read your mind when to move the slides forward. I give myself a B- on moving Michelle's slides forward, so I'll try harder this time.
Well, thank you very much, Arwen. So like she said, I am a certified public accountant and I am the senior managing accountant here at Precision Tax. When they asked us to do this presentation, one of the things that I get asked a lot, and so I decided to go over it during this presentation, is what should your business entity be? I get a lot of new clients that either automatically went and formed a LLC or S Corp, and they didn't really know what the implications are. So once I get my hands on it and really explain everything to them, it might not have been the best decision to even form that type of business. So I'm going to talk about the little differences between all of the businesses that you can choose. So hopefully if you are thinking that you are going to want to change to an LLC or a corporation or a partnership, it gives you a little insight as to what to expect. So the main business that we see is just a sole proprietorship. So you don't really have to do anything special to be a sole proprietorship. It's just you have to register with the state, the Secretary of State that you're doing business in, and you get a DBA. You can either be just a one owner, that's why it's a sole proprietorship, or if you are a husband and wife both working in that business, you can also still be technically a sole proprietorship. It's called a qualified joint venture, but it's still on your individual returns. Another thing that you can do is be a corporation. You can, if you choose to be a corporation, you are automatically deemed to be a C corporation. A lot of people want to be an S corporation. There's a lot of information out there as to you can save money being an S corporation, but if you elect to be considered a corporation, you are automatically considered a C corporation until you file with the IRS that you want to be deemed an S corporation. So if you want to be an S corporation, make sure that you follow that additional step, or else you might be hit with additional tax rates. Other things that we're going to be talking about are partnerships, and then LLCs, which is technically a disregarded entity. The IRS does not consider that to be a separate entity, so it reverts back to different ways. We're going to talk about it a little bit in future slides. So I'm going to go a little bit over the sole proprietorship taxes. So with a sole proprietorship, like I said, it's not a separate entity. So the individual owners will pay all of the business's taxes on their own individual returns. You'll just file your own 1040 return and have a Schedule C to report all of your business income and expenses. All of the net income, so that's all of your income after expenses are deducted, that's subject to the self-employment taxes that Michelle was speaking about, because the FICA and the Medicare and Social Security taxes, because you are a sole proprietorship, you are considered both the employer and the employee. So you have to pay both portions. So that comes up to 15.3%. Another thing to consider is that's just the payroll taxes. That's just the self-employment FICA taxes. You are also going to be subject to additional ordinary income taxes on that net income as well. So based on what the net income looks like, what your other sources of income look like, your ordinary income taxes, you could fall in to 10% to all the way up to 37% ordinary income tax rate, in addition to the self-employment taxes. So sometimes sole proprietorships it's the easiest route to go because it's not a separate entity. There's not a whole bunch of reporting requirements, payroll reporting requirements, but you might be having to spend a lot more money on those taxes. And then we'll move forward to the C corporation. So like I said, if you become a corporation, you will automatically revert to a C corporation. And what a C corporation is it is its own entity. And because it's its own entity and it's because it's a separate entity, it's not a flow through. So it's going to be subject to its own set of income taxes. Currently, the income tax rate on the net profit, again, after the expenses are taken out, is 21% for most corporations. But if you're a personal service corporation, such as myself, with being an accountant, doctors, lawyers, we have to get subject to the personal service corporate rate, which is currently 35%. The reason that the C corporations sometimes are not the best route to take is because you can see double taxation, because the C corporation has to pay their own income taxes. And then you also have to, as an individual, as the shareholder, you have to pay taxes on your distributions or your wages that you're receiving. So if you distribute money out of the corporate account to yourself, you can either choose to deduct that as wages, which then you have to file the payroll taxes. And that can be deducted as a payroll expense on the C corporate return, or it's considered dividends. So the dividends is where you get into the double taxation, because you're paying income taxes on it, because it's not considered a corporate expense. And then you're paying income taxes on your individual returns for those dividends that you're receiving from the corporation. So the dividends, they are subject to not income taxes. They're actually a capital gain is what it's considered. So there's different rates for that. If you look at the slide, short-term capital gains is if you have ownership of less than a year for that corporation, and it can be anywhere from 10% to 37% for that capital gains rate. And then the long-term, if you have ownership in that corporation for over a year, it can be subject to 0% or 15 or 20% based on all of your other sources of income and what your adjusted gross income falls at. We are going to be moving forward to the S corporation. So the reason that the S corporation might be a little bit more beneficial is that even though it's considered its own entity, it's considered a flow-through entity. So you have a S corporation return that you have to prepare. So if you're going to be changing into a C corp, an S corp, a partnership, you got to be aware that those do have additional filing requirements. Right now, our preparation fees for any of those business entity returns are about $1,500. So if you're going to be reverting to those, just keep in mind that you'll have additional expenses for reporting, for preparing your taxes, for paying all of those payroll taxes. There's additional payroll tax reporting services. So just keep that in mind. With the S corporation, because it's a flow-through entity, you have all of the income and expenses reported on the S corporate return, but then all of the net profit then gets actually flowed through to your individual returns. It's on a K1. So the K1 for each shareholder will show you exactly how much income, net income that will be reported on your individual returns. The S corporation, there are a lot of misguidings out there. So there's a lot of reasonable wage requirements. With the reasonable wage, with S corporations, the reason that people want to revert to an S corporation is to minimize all of those self-employment taxes that you have when you're just an S or just a sole proprietorship. But with S corporations, you have to pay yourself a reasonable wage. And the IRS doesn't really give us much guidance as to how to calculate that reasonable wage. It's just what is reasonable for what you do for that business. So how much would you pay someone else to come in and do the same services that you're providing for that business? Has to be reasonable. If you're spending all year, that's your primary source of income, it's your primary business, and you're only paying yourself $10,000. If you get audited, they could assess additional reasonable wage and make you pay additional payroll taxes because that wouldn't be considered a reasonable amount. So with the reasonable wage, because it's a wage, you are subject to the payroll taxes. Because an S corporation is a separate entity, though, you have the employer and the employee portions. The employee portion would not be considered a deductible expense on the S corporation return, but the employer portion, so half of the FICA taxes, that would be considered an expense. So it at least reduces the amount of net income to the S corporation. If you have no employees or no assets that are helping you get the profit for the S corporation, they consider the reasonable wage to be the full amount of your net income or the full amount of the amount that you took as distributions. There's a lot of nuances with reasonable wages, but just keep in mind that they consider an S corporation, they want to get all of the FICA taxes as possible. So if you are the sole owner of that S corporation, the sole shareholder, you could still be subject to the full amount of payroll taxes that you would be if you were a sole proprietorship, just because how reasonable wages are determined. And then I will move forward to the partnership. So partnerships are also considered flow-through entities. So again, you'll have the partnership reporting on the partnership return, and then all of the net income would then be flowed through to your individual returns via the K1s. How you get paid with a partnership is all of the net income based on the partnership percentages. They get allocated to each partnership or each partner based on those percentages. If you pay yourself a wage, technically a salary for the services that you're providing to that partnership, it's considered a guaranteed payment. And while that guaranteed payment is considered a deduction on the partnership return, it's also subject to the self-employment taxes. So you're still going to get hit for all of that 15.3% self-employment taxes on those guaranteed payments, those salaries that you're receiving. And then you're also going to be subject to the ordinary income taxes, the same with the net income that gets flowed to your individual return. Additional notes, just items that I have seen in my years of preparing these returns. Even if you are going to be starting a sole proprietorship business, keep separate bank accounts. It makes everything so much easier, especially at the end of the year, to categorize all of your income and expenses and not have to weed through all of the personal income and expenses that are in your personal account. So please make sure to keep a separate bank account. It just makes everything so much easier. And then separate bank accounts are also, they're actually required if you are any business other than the sole proprietorship. LLCs, S Corps, C Corps, because they're a separate entity, they need to have their separate set of books. And if you commingle funds, if you use the corporate books as your own, or you use your personal account for both your corporate and your personal income, it gets convoluted, and you could be opening yourself up to legal issues if anything were to happen and they had any type of it could just cause more problems because it's called, what is it called? The corporate veil. You're piercing the corporate veil. So if you pierce the corporate veil, if you don't segregate all of your funds, they could come after your personal assets, is what I was trying to talk about. Deductible unreimbursed expenses. There are different regulations for each type of account. If you do not reimburse yourself, let's say you have a corporation or a partnership, if you don't reimburse yourself for any personal or business expenses that you pay for personally, you might not be able to take those as a deduction. So make sure if you, let's say I go out and I use my own personal card to buy supplies, make sure that you're reimbursing yourself out of that corporate account so that you can actually take those supplies once the tax return is filed, or else you might be losing out on those expenses. Another thing that I see a lot is on all of those items, all of those entities that flow through to your personal account, losses are limited to your basis. So your basis is a calculation. It's based on how much capital, how much money you contributed to that business entity, how much fair market value and assets that you contributed to that company, any recourse debt that you took out. So that means any debt that you're personally also liable for. And then minus any distributions that you've received, minus any non-deductible expenses. And that's what your ending basis is. So if your loss exceeds that, if you haven't contributed anything and the partnership is showing a loss, you might not be able to deduct that. So just keep that in mind. If you have any situations like that, just make sure to talk with your CPA or accountant to make sure that you aren't hit with a higher tax bill than you were expecting once we prepare the returns. And another thing that I get is there's a lot of people that like to incorporate or get LLC paperwork, for example, in Delaware. Delaware is a big state that I see that in. But if you establish a business in another state and you still are doing business, let's say I establish a business in Delaware, but I'm still doing business in Idaho, you're still going to be subject to income taxes in Idaho. So just keep that in mind. That's all I had.
Awesome. You know, it sounds like a mess is what it sounds like, Star. And it sounds like I'm very grateful that my husband works with a bookkeeper because that's terrifying. Awesome. Well, thank you so much, Star. I really appreciate it. We didn't have any questions come up during the presentation, but again, we'll have some Q&A at the end that we'll open it up to. So with that, I'm going to go ahead and thank you, Ms. Starr, for all the wonderful content. I'm going to go ahead and turn it over to Miss Carrie Straw with she is the VP of HR Services with OmniaHR, and she's going to talk to us about human resources and our most important asset, our employees that help make us revenue. So go ahead, take it away, Carrie.
Awesome. Thank you, Arwen. Well, after hearing all the tax stuff, I'm like kind of glad I'm in HR, even though there's tons of regulations and laws we have to follow. I'm kind of mind blown watching all the taxes and everything. So thank you for joining me today. And so when we were coming up with what can I share, I kind of relying on all the times I've walked into employers, small businesses, and just done HR audits, looked at stuff. And so when we started the what you don't know, I really wanted to share with you things that I just found out that maybe small businesses don't know. So if I get through my slides and you're like, nailed all of that, you are doing great. So Aaron, if you want to go ahead and advance that slide. All right, so one of the things when I'm auditing is checking out personnel files. And so different degrees of what I find in personnel files, where they're stored, how they're stored. And so I just kind of wanted to do the best practices on personnel files. So why do we have personnel files? Well, one, we want to have somewhere we go where everything is documented, everything from the resume that came in, the job application, everything about that employee creates their personnel file. It's also the way that businesses defend themselves. So if I have an employee that is not performing well and I'm documenting it and I let them go and I get some kind of Idaho Human Rights Claim Commission that says I fired them for, X discrimination, it's my personnel files and everything that's in there that I'm going to be able to defend exactly what my actions are. However, when I'm looking at personnel files, sometimes I find there's things that should not be in there. Some of the main things I find in there that don't belong in those personnel records are medical situations, because we have to remember in a personnel file situation, if we do have a discrimination claim or something come against the company and that subpoena rolls in, it's to subpoena that personnel record. So we want to make sure we really look and audit what is in our personnel files. And so other things that you may have separate, maybe your payroll files that are separated out, anything to do with OSHA or work comp or family medical leave situations, you may have separate files for those as well. Really your personnel files is the demographics and the employees, documentation of performance reviews or PIP plans or things that really create that who's this employee and why are we doing what we're doing within our employment actions. So other things that I find in there, and I have the little note on the slide here is I-9s, and I do have a separate slide where we're actually going to talk more about those I-9s. I-9s do not belong in the personal records. They are to be maintained by the employer the entire time that employee is with you. So if that subpoena comes in, they should not be taking that I-9. So usually in 100% of my audits, I find the I-9s have something we need to discuss following that audit. So if anything, when we get done with this presentation, take a look and see how you're maintaining those records. And like I said, we'll get to those in just a moment. So some record keeping rules that I like to remind employers, the biggest one that I find out that small businesses don't understand is the 1-year record keeping when you actually hire an employee. So when you post that position, everything from that job advertisement, the description, every candidate that applies, you have 1 year you need to keep that data together. So maybe in your 1-year record keeping requirement for maybe you just posted for a clerk position. And so you want to keep that material for at least 12 months, that 12 months minimum. And the reason why is because if a discrimination claim comes in, maybe somebody who is a female or age 40 plus protected, and they say, hey, I think I was discriminated against, you have to show every candidate that applied, your scorecards to why you hired who you hired, and you have to maintain those for 1 year. And so that's important to make sure all of that is together. When that subpoena comes in, you don't want to try to remember 6 months ago who interviewed, where's the resumes, where's the applications. And so you want to make sure that you do have a process in place for the record keeping for your positions that you open. Another thing is I get asked, well, how long do I need to keep records? Well, it depends. There's different dates for everything. So when an employee leaves, I usually tell them it's a good rule of thumb 7 years. And that even covers like payroll items. Really, the main thing we look at that doesn't really meet that 7 years, sometimes we run into OSHA stuff. OSHA has their own record keeping rules, and a lot of times we'll see 30 years after the end of employment with that individual. So other than OSHA, general rule of thumb is we're keeping our records after employees leave for at least 7 years. Because if you just grab everything and you put your terminated people and all of their different personnel files and medical files and all that stuff in one section and put it in a box and store it somewhere, you want to make sure you're not destroying that too early in case something happens later down the road where you need to access those records, or you're experiencing an audit in one of our multiple government agencies that can walk in and say, hey, let me look at this data. So Arwen, let's go ahead and go to that next slide. Okay, so I did want to touch on I-9s. 100% of audits I've ever done have never been successful on the I-9s. It's usually minor stuff because the I-9s are so tricky and so detailed, which I'm going to talk about changes coming soon. It excites me for what I saw proposal for a new I-9s. So right now our I-9s are expired. That is okay. You can still continue to use the I-9s for your new hires, even though the expiration date was October, because the IRS and government is working on new versions of the I-9. And so one thing is, do not put those in the personnel file. Your I-9 should be their own file somewhere else, a 3-ring binder. You have a 3-ring active binder, 3-ring terminated binder, because we're going to talk about record keeping on terminated I-9s. And then nothing is left blank except email and phone number. Those can be left blank, and maybe social security number if we're talking somebody that's on a visa. But otherwise, everything else, including that last name used box that's on page 1, if it's blank, you automatically have an error on your I-9. So if you have a male who's obviously never had a different last name and he comes to employment and he leaves that blank on page 1, you could be fined in an audit. So you want to make sure you're working with your employees as they're filling out that page 1 on day 1. And then by day 3, you're filling out page 2. So often what I see on page 2 is maybe documents are swapped. So we have list A, which is your passport and items, and your list B and C, which is usually driver's license, social security card, so a different variety. Making sure every field is complete, and section 3 on page 2 was not assigned as a new hire. That says recert and rehire verification on that section. So what are the changes coming that I'm so excited? One, they're looking at taking this 2-page document and making it into 1 page, and taking that section 3 that often I see my hiring managers sign their, section 2 on page 2, and then they sign page 3 because it says employer signature. I'm like, no, don't sign that. So they're looking at removing that whole section. And then they're looking at also not making that last name used box mandatory, where if you read the instructions right now, it is a mandatory field. So if it's left blank, after our new ones, as long as these proposed rules go into place, we are just fine if we leave a blank. Right now, we're not. So if you haven't looked at your I-9s lately or done a full audit on them, you want to. You should have an I-9 on every active employee that is working for you right now. And then when they leave, you should be pulling those I-9s away from that active I-9 folder and putting them in your terminated folder along with a destroy date. What is a destroy date? It's either 1 year from termination date or 3 years from date of hire. So example would be if I hired somebody today and a week later they did not work out, I'm holding that I-9 from 3 years from the date of hire. However, I've had somebody that's worked for me for 5 years and leave, I'm holding it from 1 year from the termination date. So there are calculators out there really easy where you can just put in date of hire, termination date, and it will tell you what your destroy date is. Little sticky note, slap it on there, put it into some kind of numerical order, destroy those forms. And the reason why is if you get audited on your I-9s and you have forms that could have been destroyed, but you didn't, and they have errors, you will still pay the errors on those forms, even though you didn't have to keep them because your record keeping responsibilities expired. So one of the things I recommend anytime I audit is go through and audit your I-9s, see if there's corrections. Are you missing stuff? Do you need to redo anything? Do not get rid of the original, even if you have to redo something like page 1 or page 2 or the whole thing altogether. All right, so the next thing we're going to talk about is, I get this asked a lot. We're in at-will state, so I just want to let this person go because they're not performing well. I just don't want to have the conflict of telling them they are horrible at their job. And so I like to kind of define what we mean by at-will just cause. Now, if you're in Montana, at-will does not apply to you. It is our only state that does not have the at-will. They are just cause only, so you've got to follow your disciplinary process to the T before you actually let somebody go, unless we're talking about gross misconduct. So I usually tell all of my clients, we don't have at will. I don't like the word at will, because when I let somebody go and I bring them in and say, hey, we're just not working out anymore, even though you've been with us 10 years, and so we're going to part ways, they're going to make up their own mind and why they think you're letting them go. It must be because I'm of this age or this gender or this religion. Some protective class is going to come down, and that must be the reason you're letting them go, and they're going to file that claim of discrimination against you. So I usually tell people just cause, meaning document. Even if it's verbal, if you give somebody a verbal, hey, you're showing up late for the third time, don't do it again. You need to document that, because that's how you're going to justify. If I have that person show up late for the fourth time and I'm like, you know what, we just can't do this anymore, parting ways, you have the documentation that says, hey, they failed to show up these times. I talked to them this time. They did it again. I let them go. That is just cause. So we want to make sure we have something there. So if we do have Idaho Human Rights or Montana Human Rights, or some in Washington State EEO come in and say, hey, this employee says you did this, as far as their termination, and you discriminated, you have a way to defend yourself. And then another thing that I noticed too in last paycheck rules. And so we have our minimum wage, and the minimum wages are different, and you have to watch not just your federal, which follows state of Idaho is great, but then you get over to Washington and it's all over the place. And then we have different things like, what is Seattle's minimum wage in Tacoma? So you really have to watch that minimum wage and what you're doing with that last paycheck. There's different states that have last paycheck rules. So make sure you're looking at your state when you're actually handing out last paycheck. I ran into companies that sometimes say, well, we gave you a laptop, a cell phone, and if you don't return it, we're going to withhold it from that last paycheck. So depending on your agreement, if you look at your laws, what you can withhold from paychecks, laptops and cell phones are not listed. So if you have something signed, maybe I would still caution against it. But when you take that out of that paycheck, you have to watch your minimum wage. You can never take somebody below that minimum wage because they didn't return a company property. I highly advise that if you're giving up company assets to somebody, yes, have them sign they're responsible with the value of those assets, and then don't take it out of the last paycheck, but invoice them for it and follow them just like any other collection process of somebody that owes you money. All right, next slide. All right, one of the things I like to talk about, because our employees are our greatest assets, is the cost to you. This being taxes and payroll and everything. One of the things that are not on your P&L statement is the cost of lack of productivity and turnover. And so turnover, when we look at SHRM giving our estimates, they talk about it's 6 to 9 months of an employee salary to do everything, to create that job posting and recruiting and training and everything that it does. And so you can look at a $50K salary, $25,000 to $37,000. That's not showing on your property, P&L statement, but you've lost that money because that's the cost that it took in order to do business to get somebody to fill in and get them up to speed in that position. But there's more than just the bottom line cost. There's the impact of mental health and morale and overtime, because now you have somebody leave and that shifts your company culture and friendships are broken out. Sometimes we're okay to see somebody leave and sometimes we're not. And so really looking at how the impact of when we have turnover and what it does to our business. Our labor shortage, we just can't go out there and be like, okay, you left today, I'm just going to go put an ad and have someone tomorrow. Life does not work that way anymore with our labor shortage. So what we can be doing with the true cost of turnover and help that is you've got to train your leaders. People don't just leave their duties, they leave people that are not treating them well or don't have a good culture or don't reward them or don't value them. So train your leaders and really learn what employee engagement is and how to focus that. If you can focus and turn up your employee engagement, it automatically hits your profit and loss statement, because more productivity from your employees, because they're happy, they're healthy, they're engaging, automatically returns a higher revenue source for you. All right, Arwen. So the last thing I wanted to talk about is documents to check. So some of the things I recommend you looking at is employee handbooks. We do auditing services on employee handbooks, and I'll find things in there all the time. Main thing is the word probationary period. Unless you're union, that should not be in your handbook. That is a union terminology. Probationary period means after this point of time, I promised you something else. Well, we're at will. I don't want to promise you anything after any certain time. So introductory period would be better. I see things in there still of if you talk about salary, you'll get fired. Absolutely not. We have National Labor Relations Act that protects certain concerted activities within our workplace, like talking wages and working conditions. So please check your handbook, see when the last time you reviewed that with a professional. but definitely making sure that that is up to date. And then we have things like RAP and summary plan documents, summary material modifications. I get these words I throw out. If you have health benefits or any type of ERISA benefits, medical, dental, vision, you need to have certain documents in place for them to be compliant with ERISA. ERISAs are Employment Retirement Income Security Act. And so what that means is if you have a medical plan, you should have a RAP summary plan document, because the benefit book from the carrier does not make it ERISA compliant. Along with that, you may have to have summary of material modifications, meaning I created a RAP, said as I was with this carrier, but at renewal, I moved to this carrier. Now I need a summary of material modification that says my RAP said this carrier, but now it says this carrier. So you really need to review all of these documents in a Department of Labor audit. You're going to be forced to prove RAP and summary plan documents and other things along that line. And if you don't have them, you may find yourself scrambling. So the other important one, next slide, Arwen, is our premium only plan document. If you are pre-taxing benefit premiums, you need to have a premium only plan document. If not, and you get caught, you illegally pre-tax premiums. That could impact you and employees as far back as the first time you pre-tax those premiums. So make sure that you're checking for that premium only plan document and watching all of those documents have restating. Normally, if there's a summary material modification, you want to restate every 5 years. Other than that, it could be anywhere between 7 to 10 years, depending on the document and whether or not you need to restate it. So check your dates. How old, if you have those documents, are those documents? And then don't forget new hire annual notices. Ton of notices go into small businesses. A lot of times you may not even know that. Do you need an exchange notice? Do you need WICRA notices? All of these things that you're like, different terminologies I've never heard. Make sure that you're engaging human resource staff to be like, what notices, depending on what our business does and benefits and stuff, do I need to supply? And finally, COBRA. So COBRA is one of those things that at small businesses, you hit that 20 employee and you start writing that for a little bit. Does this become applicable at certain employee counts? Laws change. We have ADA, so we can look at Americans Disability Act, and even though it's 15 at federal, it's 8 in Idaho, or 5 in Idaho, 8 in Washington. So you have to watch as a small business. As you hit certain employee limits, laws start applying to you, and you want to make sure that you're prepared for those laws, because if you're not following those laws or offering the right things correctly, and we have an employee that you let go and they make that complaint that they didn't receive this proper benefit or this wasn't applied, all of a sudden you may find yourself with penalties and scrambling to do an audit with the government. So I know we're at our time limit right there, Arwen.
Yeah.
So
I guess my main question is for all of you, if somebody has questions about anything that they've heard about today, or they sit down, they go and they say, I'm going to audit my stuff, and then they realize I would rather have someone else do this for me. I'll start with Carrie. Carrie, what would be the process to engage with OmniaHR if that was something that somebody was interested in pursuing?
Absolutely. So they can reach out to me directly, Carrie at OmniaHR.com. They can Google OmniaHR. Our information's all over the place. You know, we do those free services that we do, auditing handbooks, just because we want to help people understand what a good handbook is, because that's one of those things that if it's a bad handbook, it's more legally hurting to you to have a bad handbook than no handbook at all. And so those are one of the things that we're like, just send us this. We also have short HR audits where we go a list of questions and grade you, and then give you some ideas of areas that you may want to focus on. So if there's anybody needing assistance on those, or they're like, we don't want to audit this, we'd rather have a professional come in and audit, those are services we do too at cost.
Awesome. And then Star and or Michelle, whoever wants to take that one, if somebody wants to engage with Precision Tax on anything that they've heard about today, or they have questions, or they're going, I don't know if I should be an S Corp, or what does that look like? What would be the process to engage with Precision Tax?
I'll take my portion. So I guess it would depend on what type of services they would be looking into or looking for guidance. If it's tax related services, tax preparation services, they can call our office. We do offer either hour consultation at $250 for the hour consultation, or if they would like us to prepare the returns, we just require an engagement letter, and then payment is due upon the completion of the returns. Our phone number here is 208-215-7245. And then I will hand it off to Michelle because there's different requirements for the bookkeeping side.
Thanks, Star. For bookkeeping, the best bet, if you've got some bookkeeping related questions, or you're thinking maybe I should outsource my bookkeeping, call that same number that Star gave you, 208-215-7245. Let them know that you have some questions or you'd like a consultation, and we can chat about it. There's a lot of variations because there's so many variations in the business. There's a sole proprietorship that, just the one guy and he doesn't have employees. That's going to be a lot different than a business that has, 15, 20 employees and maybe multiple locations. So we really just need to have kind of a conversation and figure out what your needs are based on the type of business, the size of your business, the entity of your business. Give us a call, or you can reach me via email is another way, and that's mwalsh@precisiontax.com. And I'm always happy to, chat, email, talk on the phone, whatever works for you, to try and help answer those questions. I really see all of us here in what we're doing is really trying to help small businesses keep functioning and grow instead of getting bogged down in just all the compliance issues. I mean, I was amazed listening to Carrie, how much is related to HR, and even with Star, and we're in the same office. So many things related to tax. So I think if we can help small businesses stay out of trouble and help grow their businesses, that's really what we're all about.
Awesome. Well, thank you so much, everyone, for your time today. Thank you so much for everyone who attended. And I think Michelle hit the nail on the head, is that all of these aspects of HR and taxes and bookkeeping and payroll, these are all full-time jobs, and you want to focus on what you want to focus on, which probably isn't anything that we do. So if anything today, you have questions or any follow-ups, I've put Carrie's email in the chat, as well as Precision Tax's phone number and Michelle's email address. Following this presentation, we'll be sending out the recording, your SHRM CE credit, if that was something that you would want, as well as a copy of the slide deck. So thank you, Carrie and Star and Michelle. Thank you so much for being here today, and I greatly appreciate your knowledge and your insight. And I hope you have a great afternoon, everyone. Thank you.